Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The coronavirus has now claimed more than 3,000 lives across the globe and more than 89,000 people affected as per the latest data available. The OECD lowers its global growth forecast to 2.4%, citing the coronavirus outbreak. It's the lowest projection since 2009. The rupee ends at its lowest level in a year after 2 new cases of the coronavirus in India spook investors across the board. And SBI Cards' IPO is subscribed 39% at the end of day 1. Keep in mind, it's a 4-day IPO and not a 3-day IPO, so 3 more days left for the subscriptions to take place. But that's not what we're starting off today's session with, the trade setup. And it's a remarkable difference between what happened overnight in the US markets and what's happening in Asia. First, what happened in the US markets? Look at those gains. 4.6% for the S&P 500, 5% for NASDAQ. The techs rallied too, and 5% for Dow Jones, and the techs rallied and the NASDAQ ended up about 4.5% as well. Frankly, tech led the rally, and there were outsiders which pitched in, as a result of which this 1,300-point uptick on the Dow Jones. It's after a while, I think after 2 years or thereabouts, that the US markets and all 3 indices together had a rebound of 4% in tandem. I think it dated back way to December 2018. So it's been a long time that such a large move has happened across the 3 indices in the US markets. But is Asia taking over or taking on that? Well, maybe not. You would argue that, yeah, Shanghai is up about 1.27%, but Hang Seng, Nikkei, very, very flattish. Kospi is less than 1% higher, and the SGX Nifty 2 indicates a start which is very, very flat. Now, mind you, India had its own issues yesterday, and we've seen that until yesterday, by being in tow with the globe, and yesterday diverging from what the globe was doing, the Nifty's now had some serious cuts, about 1,000 points in the last 7 days alone, and that's a very sharp slide that we've seen in the Nifty 50. Some people say that it's oversold as well. Frankly, if you look at the Bloomberg terminal and the RSI indicators, yes, the Nifty does look a bit oversold, and from these territories, it's typically bounced back. So can we, if indeed there is a global bank coordinated action later in the evening today, see the bounce back for world markets and the Nifty? Maybe. But I think yesterday what spooked the Nifty was local cases. A lot of arguments around both sides that there were 3 cases anyways there, 2 more cases identified. Was there a need for such a sharp sell-off? But the market is in a zone right now where it doesn't want to take any chances with bad news, and therefore the markets came off. And I think that's the key question. Can the Indian market shrug off the local coronavirus fears? Even if there is a global coordinated central bank action today, can Indian market shrug this off? I think during the course of the day, we'll probably get the answers to that. So frankly, I'm limiting this trade setup to that, because it's all about what the markets and the sentiment around the local fears on coronavirus would be. It's very difficult to preempt what would happen, so let's not try and second guess that. The technical indicators, as I said, indicated that maybe there could be a start, or maybe there could be a bounce from these levels. Whether it happens today, tomorrow, time will tell. Some stocks that you should monitor, though, in the session today. We've spoken about how auto names have corrected. Yesterday, while Eicher was doing well, Bajaj Auto and Hero MotoCorp were down. And Hero MotoCorp, the numbers haven't turned out to be all that great. So the February sales were down about 19%, 4.98 lakh units versus an estimate of 5.1 lakh units. Not great news, but let's see how Hero reacts in the session today. I'm particularly interested in seeing what happened to all of these companies which rely on public spend, maybe crowd spending, and all of which corrected quite viciously in trade yesterday. Inox Leisure, 12.5% lower, PVR, 9% lower, SpiceJet corrected, Phoenix Mills corrected. So almost everything related to what could happen to leisure spend, travel, I mean, the likes of SpiceJet, Delta Corp, etc. also corrected. So these are the stocks which are firmly in focus in trade today. Credit Suisse has come out with a note on Lupin in their Asia Pacific note. They've spoken about Lupin. They say that the price is very close to their gray sky scenario, and therefore there is limited downside. They believe, according to them, that the stock price currently values only the India and the emerging markets franchise on FY21 earnings, and everything else is not being given adequate valuation. Let's see if Lupin has some positive outing today or no. And from amongst stocks which a lot of brokerages are talking about. The cooling solution stocks are in focus, and I've used the City note on Voltas here to highlight that. They've maintained the buy with the target price of 794, but essentially the point that they are making is that the hotter than usual summer bodes very well for air conditioned demand. So you watch out for all of these air conditioner, air cooler, refrigerator companies. You might actually see some buoyancy in sales this time around, and maybe the street at some point of time will price that in. So let's see if the likes of Voltas or some of the others have a day of bounce in the session today or not. That's all that we have on Trade Setup today. Let's tell you what's lined up on First Word. Investors who have shown interest in Yes Bank have put forth a rider that could be tough to meet. Vishwanath Nair will bring us that exclusive. SBI Cards IPO is underway, but how do you value the company? Shefali Malik will tell us how analysts are looking at it. And Somit wraps up by telling us by analyzing the impact of lower natural gas prices on Indian companies. On to an exclusive. Yes Bank's potential investors have laid down a tough condition. People with direct knowledge have told BloombergQuint that the 4 investors which have shown interest want participation of sovereign banks in the capital raising exercise. Vishwanath Nair joins us now for more on this story. Vishwanath, why such a condition? What's the importance and significance of such a condition?
Good morning, Neeraj. So, as you said, yes, what the investors are seeking as part of their non-binding term sheet is that apart from their own funds, which will go into the bank, into Yes Bank, they want some sovereign banks to also participate. The idea behind that is essentially when the sovereign banks will come in, depositors of the bank, of Yes Bank, will be more confident, and thereby eventually the banks, the investment in the bank will get safeguarded. That's the key idea behind all of this. But of course, it puts the bank in a position because Yes Bank is no position to ask a sovereign bank to come and invest in it. Firstly, you will need RBI approval to have a one bank hold stake in another bank. Secondly, you will need the SEBI concessions as far as the pricing of the whole fundraising issue is concerned, as well as you will need the government to come into the picture because the government is the largest shareholder in these sovereign banks. So obviously, the government has to approve something for it to go through. So all of these issues matter as far as this fundraising issue is concerned, and the bank as of now, Yes Bank as of now, is negotiating everything that they can. They did respond to a query that we had sent across last evening, and what they said that the story is speculative, but the idea that these requests have been made in a non-binding fashion. It shows that if the bank wants to raise money in the current market and its current financial position, it has to meet some very, very tough conditions, and this is probably one of the preconditions that was laid down in the term sheet. There are multiple others which we can't report as of now, but these investors are seeking quite a bit from the bank to be able to put in funds into it, and that shows where the bank and its fundraising plan stands at this point in time. Navneet Gill joined in March last year. In 12 months, he has been trying very hard to raise that $1.2 to $2 billion that he's been promising to raise. So far, there was just this one QIP issued about $275 million that happened in August last year. Apart from that, the bank has not really been able to raise funds from the market. So, these things matter.
Yeah, they do matter. And Vishy, interestingly, yesterday itself, I mean, we saw, I'm not saying it's because of this, but there's a crack in the Yes Bank stock price. The futures are trading at a much higher discount, the spot as well. But this effectively makes what is already a very tough exercise for Yes Bank to carry out even tougher. And if I understood you correctly, this tough condition is one of the many that could actually either delay or make this fundraising exercise a lot harder.
As of now, it does make things harder because it's not something that the bank is in any position or prepared to allow. It has to negotiate with other stakeholders and get them on board. That's the only way it can go ahead. They have set March 14th as the deadline for themselves to announce their December quarter results, which they haven't done so far. But it's about 12 days away, 11, 12 days away, and to be able to negotiate such tough conditions and to get all the regulators on the board, seems a little difficult.
Yeah, well, maybe results might be declared, if at all, without any definitive indication of who the investors potentially
and that could be far more, difficult pill to swallow because the bank has. The reason it delayed the results was because it was assessing or talking to investors. And if it is not able to do that before the 14th of March, then that becomes a little difficult.
Just wondering, Vishy, maybe this is a difficult one to answer, but I'm throwing this out of the blue at you. Were these conditions that we've gone to know, are they very recent ones or fresh ones, or have they been there for some time now?
No, so these the term sheets that have gone to the bank have gone only last month, only in February. So the bank
very
has
recent one.
Yes, so the bank has been sitting on it, which means that there's also that problem of time. To meet all of these conditions, you do need a stretched period of time, and if you're going to put that March 14 deadline, things become a little tight.
Okay. Well, very interesting. Vishy, thanks so much for putting that into perspective. That's a BloombergQuint exclusive, and I'm sure a story around this would be on our website. If not now, then a few, in an hour or two from now. So do log on to our website and try and read more about this. But this just makes the case for Yes Bank fundraising even more tougher. Let's wait and watch. March 14 is the revised deadline that Yes Bank put out for its results declaration. It'll be interesting to see. Viewers, remember, remember when we did the earnings comparison, we spoke that how it's not exactly an apples to apples comparison because we had only 49 stocks and not 50 stocks coming out the results on the Nifty. Then Yes Bank, of course, a different case in point right now. Let's move on. It's a 10,000 crore IPO that every market analyst expects will be oversubscribed. SBI Cards is the first pure play payments company that's set to get listed, and its uniqueness also poses a peculiar problem. How do you value this company? The MD and the CEO who spoke to us believes it should be priced to earnings and not priced to book basis, as is typically done for banks and NBFCs. But what do analysts have to say? Let's find out from Shefali Malik, who joins in with the broad analysis of how would the street typically value SBI Cards. Shefali, good morning.
Good morning. So actually analysts have given me very different views on the same. Most actually believe, they actually agree with the MD that it should be valued at price to earnings and not price to book. Some have gone even further and said that probably PEG ratio, which is price to earnings relative to its growth ratio, so that would be a better metric. So why this problem in the first place? Because we've been telling the viewers that half the income comes from interest income and half is from fee and other income. So interest income is a more cyclical component, so probably price to book would be better. That is a view coming in from some of the analysts. And fee and the other income is a more sustainable linear one, and more fixed in nature. So probably for that, and that makes the earnings a bit more predictable. So in that sense, price to earnings would be a better multiple. So you compare SBI Cards with the global peers on these metrics. Now, why not domestic players? Because there's no other pure play credit card company. Some of the banks are doing really well on that front, but still a very small portion of their book. For instance, HDFC Bank, RBL Bank, for RBL Bank, I think it's 10-12% of their book. For HDFC Bank, it's somewhere around 5 to 7% of their book. So still very small when you look at some of the global peers. So there are some US-based, some Asia-based banks and pure play credit card companies that have picked out. So for SBI Cards, the price to earnings is 45.8. These are all FY20 numbers. I didn't go any further because it's just annualizing the 9-month figures. So then you look at the capital one. So that is just 7.83. That's a big one in US. And then Krung Thai Bank, that's Thailand-based bank, Samsung Card, Credit Saison, they're all 8 to 10 times. Synchrony Financial, which is again a very big one in US, that's also 8 times. Eon Thana, again a Thailand-based entity, 8.67 times. Now Discover provides both network and issues cards as well. That's again 7.7 times in terms of just PE. Amex, which is again a very big one in US, the largest card issuer. Visa, MasterCard, not strictly comparable because they are network providers. So their PE is about 30 times. Amex is just 13 times, whereas they issue much more cards in comparison to SBI Cards. So State Bank of India, strictly in terms of price to earnings, looks the most expensive. Now you come to the price to book, because some analysts are still of the view that it's still pseudo lending. so if not entirely lending. So in that in those terms as well, it is still expensive than most. Price to earnings, price to book is 15 times. Capital One just 0.7 times. So for a lot of them, its price to book is below 1. Capital One, Krung Thai Bank, Samsung, Credit Suisse, Song, for all of them, it's below 1. For some of them, above 1, Synchrony Financial 1.4, Aeon Thana 1.6, Discover as well. Amex, Visa are another case in point because there's a more fee income focused business. So probably for them, price to book is a better multiple. So 3 or almost 4 times for Amex, Visa 11 times, Mastercards it's almost 40. So it's like really high in terms of price to book when it comes to these few companies. PEG ratio, the last one, and some are of the opinion that probably this is the best one to look at because this is price to earnings relative to the growth. So anything above 1 as per this ratio is slightly expensive, and anything below 1 is a good buy when you factor in the growth as well. So SBI Cards 1.2, Capital One is a notch above that, 1.25. Mastercard is one of the highest, 1.83, and a lot of them are below 1. But even like in the case of PE as well, let's say if or a price to book, just because something is looks expensive based on those parameters is not always. For instance, when you look at some of the FMCG companies, they are very highly valued, or Bajaj Finance, HDFC Bank. So 1.2. Considering the kind of high growth rates may not be looked like in that sense.
Yeah, well, so there are pros and cons of trying to compare these to the others as well, right, Shefali? For the FMCG companies, just the quantum of cash flow that they throw up and the return ratios that an HUL has, for example. So it's just a different breed altogether.
Yeah.
The question that a lot of people have posed when people are trying to compare an SBI Cards to an existing Bajaj Finance or HDFC Bank, even though SBI Cards has history, just the declared proven history of a Bajaj Finance versus an HDFC Bank versus this one is different. But my question, though, largely is this, Shefali. Are people in their analysis extrapolating the growth rate by SBI Cards in the last 4 years for the next 3 or 4 years? Are people doing that? Because
yes.
The arguments then people would then make is that the PEG or the P to growth ratio on a FY22 basis would be a lot more reasonable.
Well, yes, people are factoring in strong growth to happen for SBI Cards in the next few years as well, purely because of the under-penetration level that we have in the country. So very strong growth being factored in for the same, and hence most of the people have recommended a subscribe rating that at least for next 3 years, let's say, there is a very strong growth visibility.
Okay. Well, interesting. Thanks so much, Shefali, for putting this into perspective. Remember, out here, Shefali's attempt was not to try and say that price to earnings or price to book or PEG is the better ratio, but she's putting out all that is there for this mega issue, the largest one in the current financial year. And a story around this on our website as well. It was on the homepage yesterday. Do log in and try and read more about how the street is looking to value SBI Cards, or simply just rewind and hear this video. Okay, let's move on. The last piece on First Word. There has been a sharp fall in natural gas prices in the global markets, but it has a different impact on different Indian companies operating in this space. Sumit Sarkar is standing by to tell us which of them takes a hit and which ones benefit. Good morning, Sumit.
Good morning. So if you see the Asia spot LNG prices have fell to its new low in February 2020 owing to various factors. Firstly, lower demand, supply glut, high inventory and demand concerns linked to coronavirus. Now the Japan-Korea marker, also known as the JKM price, which is now the Asian benchmark for gas prices, have fallen below $3 mark for the first time in February 2020. So how does it impact the Indian gas companies? While for GAIL, the impact has been negative. Now GAIL buys LNG at contracted prices in the international market and sells them at a prevailing rate in both the domestic and the international and the other international market. This is the Asian market that I'm talking about. Now this fall in buying price has been, the fall in the buying price of GAIL has been low, as you can see in the chart. Along with this, there are some fixed cost elements, like there's a markup of 115%, there's a fixed cost element, and there's transportation cost. Now this is, we are talking about the gas that GAIL imports from the US market. Now they follow the Henry Hub prices. There's a markup of 115% on those prices. Then there's a fixed cost of $3 and there's a transportation cost of $1.75. Now what happens because of this is that the landed cost of this US LNG in the Asian market has been higher. As you can see, it has been at a premium from the first quarter of financial year 2020 and so far in the fourth quarter of financial year 2020. But what has happened now is that in the fourth quarter of financial year 2020, the premium is literally double. Now the average Asia spot LNG price is close to $3.44, while the landed cost of this US LNG contract is nearly $6.98 per million British thermal unit. That is nearly double of what the average Asia spot prices is. Now because of this, the gas trading business of GAIL will take a hit in the fourth quarter of financial year 2020. Now if you see the gas trading business of GAIL, the EBIT has been trending lower compared to what it was earlier because of this premium of the landed cost of US LNG. Now in the third quarter it did bounce back, and that is because the premium had contracted, but in the fourth quarter again, as the premium has nearly touched 102%, the number is expected to be impacted. Now who will benefit because of this lower gas prices? Well, city gas distributors, because this can not only spur the demand for gas in India but also benefit their margins in the fourth quarter of financial year 2020. But of the three city gas distribution companies, that is Gujarat Gas, Indraprastha Gas and Mahanagar Gas, Gujarat Gas tends to benefit the most, and there's a reason behind this, and that is because the domestically produced gas in India is mandated to be used by the city gas distribution companies only for the household and transportation purpose, but the imported gas, that is the gas that GAIL gets in India, is been used for industrial and commercial purpose. And if you see the sales profile of all the three city gas distribution companies, Gujarat Gas benefits the most because 69% of the sales volume is generated by supplying gas to industries and for commercial purpose, as against 13% for Indraprastha Gas and nearly 13% again for Mahanagar Gas that we have seen in the sales profile volume. That's the reason why Gujarat Gas benefits the most because of this fall in the LNG prices that we have been seeing. And if you see the past trend that we have collated for Gujarat Gas, whenever the Asia spot prices have averaged lower compared to last year, Gujarat Gas margins have increased compared to last year. Now, as you can see in the fourth quarter of financial year 2019, when the Asia spot prices were down by nearly 4%, the Gujarat Gas EBITDA per SCM, that is the unit margins, were higher by nearly 19%. And in the third quarter of financial year 2020, when the prices were down by nearly 19%, the EBITDA per SCM, that is the unit margins of Gujarat Gas, were also higher by 19%. So this clearly shows a trend that how lower spot LNG prices have been benefiting Gujarat Gas. Obviously the benefit will also come in for IGL and Mahanagar Gas, but it will benefit the most to Gujarat Gas in the fourth quarter of financial year 2020.
And brokerages seem to be bullish on that one compared to the others as well.
Yes, exactly.
Okay, so city gas distributors tend to benefit likely the most out of this.
Yeah.
Okay, Soumit, thanks so much for putting that into perspective. Interesting analysis on the impact of this lower gas prices on various subsets within the pockets that get impacted. That's all that we have on First Word today, though. But lots more lined up on Indian Open. Market levels in this bout of correction. Gautam Shah of Goldilocks Premium Research, he joins in at 9 a.m. We talk about fundamentals with Mihir Vora of Max Life Insurance, and business outlook with Abhinav Gupta of APL Apollo Tubes. And IRDAI is considering allowing life insurers to offer indemnity-based health policies. We examine the implications with former LIC chairman S.B. Mathur.